Welcome to Neon Primer Go-to-Market, where Vega and Axon break down go-to-market strategy for founders who are done guessing. New episode every week.
Imagine waiting 19 days after the end of the month just to find out if your business actually made any money.
Right. It's wild.
You are flying completely blind for over half the month, making payroll and, inventory decisions on pure guesswork. And for nearly 2 million organizations in the US right now, that isn't some hypothetical nightmare. That is their daily, painful operational reality.
Yeah, it really is.
So whether you are a founder trying to scale your company, a business operator looking for a competitive edge, or just someone fascinated by how traditional old school industries are completely transforming right before our eyes, we are going on a journey today.
Right.
We are looking at the ultimate playbook for modernizing a legacy business.
And looking around at the data charts on the bookshelves behind me, the numbers driving this transformation are just staggering.
They really are.
We're dissecting a comprehensive 2026 strategy document titled The Most Effective Go-to-Market Strategy for Accounting Services. But let me be clear right out of the gate here. While the data is anchored in the financial world, the mechanics we are about to unpack are universally applicable to literally any professional service industry trying to survive the next decade.
Okay, let's unpack this. Because our mission for this deep dive is to extract the blueprint for how an entire profession is abandoning the grueling, outdated, billable hour model and morphing into these high-growth, tech-enabled recurring revenue machines.
Exactly.
If you run an agency, a consulting firm, or even like a specialized law practice, you should definitely be taking notes. Let's start with the first massive shift we saw in the sources, the death of the generalist and the rise of the niche.
Yes.
The data shows this model called Client Advisory Services, or CAS, grew by 17% in 2024. That growth rate is massively outpacing the broader accounting profession. It's a complete shift away from just filing taxes once a year.
It's the transition from looking backward to looking forward. The new holy grail for these firms is vertical expertise.
Right.
They are productizing their services and positioning themselves not as a third-party vendor, but as an outsourced finance department. The days of the broad, generalist, hours-based firm.
The firm that takes any client who walks through the door.
Exactly. Those days are effectively over if you want high margins.
I always think about the traditional accounting firm like a classic American roadside diner. You walk in, and the menu is literally 10 pages long. They serve everything from pancakes to lobster.
Oh, that's a great way to look at it.
Right. But to serve that massive menu, the kitchen needs a deep fryer, a flat-top grill, a pizza oven, and like a massive walk-in freezer holding 50 different ingredients. Because they are trying to be everything to everyone, the supply chain is chaotic, the overhead is massive, and the food is, well, it's just okay. It's great at nothing.
That is a perfect way to visualize the operational bloat.
Yeah, but this new high-growth model is like an exclusive omakase sushi bar. It is highly specialized and premium. The chef serves one type of cuisine to one specific type of client. And the reason that omakase bar is so much more profitable isn't just because the food is better.
It's the predictability.
Exactly. The supply chain is entirely predictable. The chef knows exactly how much fish to buy every single morning. They don't need a deep fryer. That's what these modern firms are doing to their software stacks and their workforce. Predictable supply equals predictable margins.
What's fascinating here is how perfectly that operational efficiency aligns with the underlying psychology of the buyer.
How so?
Well, buyers do not purchase accounting in the abstract. Nobody wakes up in a cold sweat and says, I'd really like to buy some accounting today.
Right. Nobody has ever said that.
They purchase relief from a specific operational bottleneck. They buy a solution to a highly specific, agonizing problem. When you market yourself as a generalist diner, you aren't speaking to that specific pain.
But if we are closing down the roadside diner to open this highly targeted omakase bar, the immediate question is scale. How many potential customers are actually out there for a menu that only serves one very specific dish?
A nearly unfathomable amount, honestly. Broad global market reports size the accounting services market at $683 billion in 2025.
Wow.
And it is projected to cross the $1 trillion mark by 2034. That is a literal trillion-dollar pie.
And when we look at the United States specifically, the structural driver behind that $1 trillion is the sheer volume of small and medium enterprises. SMEs make up 99.9% of all businesses in the U.S.
Which is huge.
We're talking about 5.58 million employer firms out there.
But you cannot treat those 5.58 million firms as a monolith. This is where the concept of pain states becomes critical. The strategy dissects these customer segments by what specifically is hurting them at their current stage of growth.
Right. It's about the specific headache.
Exactly. Let's look at the baseline. Small and mid-sized businesses, or SMBs, 45% of them report having chronic cash flow problems, and 60% are waiting over 30 days to get their invoices paid.
So for that everyday SMB, their pain isn't, I need highly complex, board-ready financial statements.
No, not at all.
Their pain is the absolute terror of realizing I can't make payroll next week because my clients are ignoring my invoices.
Exactly. But if that SMB survives, scales up, and, say, doubles its headcount, their pain transforms. That brings us to the mid-market. According to a 2025 CFO Pulse survey, it now takes more than 60 days to fill a single accounting role.
2 whole months.
Right. So the trigger for hiring an outsourced firm in the mid-market isn't cash flow anymore. It's organizational strain. The company's infrastructure is buckling, and the founders simply cannot hire in-house talent fast enough to keep up with the complexity.
And then there's the startup segment, which, operates in its own bizarre universe entirely.
Oh, absolutely.
The strategy highlights that startups are highly event-driven. A startup doesn't usually just gradually realize they need better accounting. An event forces their hand. They are doing a series of venture capital raise, or they need a 409A evaluation.
Which is a whole different beast.
For anyone outside the tech bubble, a 409A is essentially a mandatory IRS appraisal a private company needs before they are legally allowed to hand out stock options to new employees. Startups need an accountant who inherently speaks the language of venture capitalists and fast-paced equity events.
Which brings us back to the statistic you opened with.
The nonprofits.
Yes, the nonprofits. This might be the most revealing segment in the entire data set. There are over 1.9 million registered nonprofits in the United States, and their internal finance teams report an average close time of 19 days.
Which means they don't get their January financial reports until the end of February.
Precisely, and it's incredibly labor-intensive. 93% of nonprofits have to deal with complex fund reclassification, and 72% struggle with chronic staff turnover in their finance departments.
Hold on, let me push back hard on this.
Okay, go ahead.
If I'm an ambitious business owner looking for a lucrative niche, the nonprofit sector sounds like an absolute nightmare. You have intense government oversight. And that fund reclassification you mentioned.
Sure.
That means if someone donates $50,000 specifically to buy new computers for a school, you have to track every single penny to prove it didn't go toward paying the principal's salary. It's an auditing minefield. Why on earth would an ambitious accounting firm actively choose that headache as their specialty?
Because standardized paying is profitable. That is the secret to the entire playbook. Firms like BTQ thrive in the nonprofit sector exactly because the paying is high, it is recurring every single month, and most importantly, it is highly specialized.
Okay, I think I see where you're going with this.
A generalist diner cannot handle government grant compliance efficiently. They have to reinvent the wheel for every client. But if you build an entire technology stack and a specialized workflow dedicated solely to nonprofit grant management,
It becomes an assembly line.
yes, what is a customized nightmare for a generalist becomes a highly efficient, high-margin assembly line for you.
Ah, I see. You isolate the headache, build a machine to cure it, and run the machine on repeat. But that brings up a massive logistical hurdle for you listening right now. Once you identify that massive pool of clients with a specific recurring headache, how do you actually charge them?
Right.
How do you avoid trapping yourself in the same old billable hour grind where your income is capped by how many hours you can stay awake?
You completely dismantled the old pricing architecture. Hourly billing is dead for core recurring services.
Mm-hmm.
The strategy is unequivocal on this.
Dead.
Completely.
Yeah.
In its place, fixed fee and tiered subscriptions are completely dominating the market. We're seeing a distinct 3-tier architecture become the industry standard.
The 3-tier model, this is where we see the productization of a service. Tier 1 is the foundation. This is your basic keeping the lights on service, right? Bookkeeping, bank reconciliations, and a tax-ready close at the end of the year. The market data shows this usually ranges from about $199 to $749 a month.
And once a business outgrows the foundation, they move to Tier 2, which is growth. This includes everything in the first tier, but you start managing accounts payable and receivable workflows. You coordinate payroll, you build KPI dashboards.
And the price jumps.
It does. That tier jumps significantly, running between $750 and $2,500 a month.
And finally, Tier 3 is strategic finance. This is the top of the mountain. You are providing fractional CFO support, leading board reporting, and building complex cash forecasting models.
The really high-level stuff.
Right. That tier starts above $2,500 and can run all the way up to $16,000 a month for highly complex, fast-growing startups. But I notice a massive warning light flashing in the data regarding that entry-level tier.
Yes, the 2025 Ignition benchmark data. It explicitly warns that charging below $500 a month for bookkeeping puts a firm in a danger zone of unprofitability.
Why is that? I mean, if it's automated.
Think about the underlying costs. Even if the work is heavily automated, you are still paying monthly subscription fees for the client's software licenses, you're maintaining secure portals, and you're answering their emails. If you charge $200 a month, the software costs and just one 15-minute phone call completely wipe out your profit margin before you've even touched their ledger.
Here's where it gets really interesting to me. The psychology of this fixed tier pricing model shifts the dynamic between the buyer and the seller entirely.
It really does.
When you bill by the hour, the client scrutinizes every single minute. They are buying your tasks. But with these fixed tiers, buyers are buying an outcome. They are buying the promise of, we will close your books by the 10th business day of the month, guaranteed.
They don't care how the sausage is made.
Exactly. They don't care if it takes your software 1 hour or your human team 10 hours to do it.
Right.
They are paying for the peace of mind.
But, and this is crucial, peace of mind for the client means a massive transfer of risk to the firm, which is why scope discipline is paramount. If you charge a fixed fee, you're absorbing the risk of inefficiency.
Wait, I have to challenge that. If I'm an accountant taking on a messy new client who hands me a chaotic digital shoebox of thousands of uncategorized transactions, a flat fee sounds like financial suicide. I'm absorbing all the risk of their internal mess.
That is precisely how legacy firms bankrupt themselves when they try to transition. They offer fixed pricing without implementing scope discipline.
So what happens?
Well, as a client grows, they add more transactions, they hire more employees, they open 3 new bank accounts. The volume of work naturally increases. If you do not have strict contractual boundaries that trigger change orders and force the client into the next pricing tier, what we call scope creep will absolutely destroy your margins.
You end up doing tier 2 work for tier 1 prices. Okay, so you've closed the diner, you've built the perfect 3-tiered fixed fee omakase menu, and you have ironclad scope discipline. But if you build it, will they actually come? If you're listening to this and you've perfectly optimized your service offering, how do you actually get clients in the door?
You have to build a trust-first demand engine. The marketing data reveals a stark contrast between firms that are scaling rapidly and those that are stagnating. High-growth firms spend 2.1% of their revenue on marketing.
Which is a lot.
That is double what slow-growth firms spend.
But it's not just about throwing money at ads, it's about the mechanics of how they spend it. And the statistic that completely blew my mind was about referrals. In the traditional professional services world, word-of-mouth referrals are everything.
Right, the lifeblood of the industry.
But the data shows that the highest growth firms actually rely 34% less on referrals than their stagnant peers.
Because a referral-only model is fundamentally passive. You cannot control or forecast when your clients will recommend you. High-growth firms use what is called referral-amplified inbound.
Right, they aren't waiting for the phone to ring. They are actively using SEO, publishing high-value educational content, and hosting webinars tailored strictly to their specific niche to generate their own demand.
Generating their own gravity, essentially.
Exactly. And then they use partner referrals, like a software vendor recommending them, to amplify the trust they've already built. And what's fascinating is how their sales motions change depending on what they're selling. They match the sales strategy to the annual contract value, or ACV.
This is a crucial lesson in unit economics. ACV is just the total revenue a single client brings in over a year. If you are a firm like Bench, selling lower ACV foundational bookkeeping, you cannot afford to pay human sales reps to close those deals.
So what do?
So you use a self-serve model with free software trials.
Yeah.
The product sells itself.
But if you are a firm like Concero, Pilot, or Cruise, and you are selling complex fractional CFO services for $5,000 a month, nobody is swiping their credit card on a self-serve website for that. That high ACV requires expert, consultative inside sales teams to close the deal.
And underlying all of this marketing and sales architecture is a rapidly shifting competitive landscape fueled by technology. Intuit recently reported that 95% of accountants say automation tools like bank feeds that auto-categorize transactions using machine learning are significantly boosting their productivity.
95%.
Yeah, but it isn't just software getting better. The players on the board are changing. Private equity is stepping into the arena in a massive way. The strategy highlights players like Crete Professionals Alliance, which is currently deploying $500 million on an AI-enabled accounting roll-up strategy.
Let's pause there. $500 million. If I'm listening to this as a small independent accounting firm or, a boutique marketing agency, how do I possibly compete with a $500 million private equity juggernaut armed with AI?
If we connect this to the bigger picture, the answer lies in the hybrid model. The source research concludes that the absolute best performing model isn't pure tech and it isn't pure human. It's a hybrid.
Yeah.
You have to maintain the deep personal trust and relationship of a traditional advisor, but you wrap it in the strict packaging discipline of a SaaS company, and you hyper-specialize your knowledge like a boutique operator.
Best of both worlds.
Exactly. You use technology CRMs like HubSpot to track leads, billing platforms like Ignition to enforce your scope discipline, and AI for analyzing financial variances. You don't just hide that tech in the back office, you feature it in your go-to-market strategy.
Because showing a client your sleek, automated tech stack proves to them that you are fast, secure, and modern.
Precisely.
So the blueprint is brilliant on paper. Find your niche, package your 3 tiers, automate the back office, and sell outcomes instead of hours. But what happens when the rubber meets the road? What are the hidden landmines that blow up this blueprint during implementation?
Implementation risks are everywhere, and the strategy outlines several critical guardrails. The first is the risk of overly broad positioning.
So hedging their bets.
Right. When firms transition to a niche, they often panic. They try to hedge their bets and keep a few legacy clients who sit completely outside their new niche. That dilutes their marketing and fractures their streamlined supply chain.
The second massive landmine is delivery failure during onboarding. Look at this mechanically. If you are spending marketing dollars up front to acquire these clients, your customer acquisition cost, your CAC, is high.
Very high.
If your onboarding process is clumsy and you take weeks to get access to their bank feeds, the client gets frustrated. If they churn and leave in the first 3 months, all those projected financial gains are completely erased. You actually lose money on the client.
And then there's the compliance piece, which has evolved. Compliance isn't just a legal requirement to keep you out of jail anymore. It's an active marketing tool.
Oh, interesting.
Buyers are intensely scrutinizing credentials. They are looking for state CPA licenses, adherence to IRS PTN rules for tax preparers, and strict compliance with the FTC safeguards rules regarding data security.
It's a trust signal.
Exactly. When you mandate that a client use a secure, encrypted portal workflow instead of emailing you spreadsheets, you aren't just protecting their data. You are actively signaling credibility. You are proving that you treat their financial life with the utmost professionalism.
Which brings up a really dangerous trap: compliance drift. I can easily see how an ambitious firm could trip over its own shoelaces here.
Oh, absolutely.
You're growing fast, you land a lucrative client, and it's a huge win. But suddenly, you realize that client just opened an international subsidiary in London. Now, instead of just dealing with the IRS, you are tangled up in the FATF global anti-money laundering guidelines, or you're trying to figure out European IFRS accounting standards, which your team has absolutely no idea how to navigate.
Compliance drift is a silent margin killer. You have to decide early and in writing what services you will and will not provide. If you do not have the internal legal and compliance architecture built specifically for cross-border tax work, you must have the discipline to say no to that revenue.
Because it breaks the machine.
Saying yes will break your assembly line, which is exactly why the document provides a very strict, sequential 12-month implementation roadmap.
The roadmap forces patience. It keeps you from trying to boil the ocean all at once. The first 90 days are strictly about locking in the niche and rewriting your website positioning. You don't try to scale yet.
No, not at all.
Days 91 to 180 are entirely about building your demand pipeline and standardizing that fragile 30-day onboarding process we talked about. You only actually start attempting to scale the business and aggressively add clients in the second half of the year.
It requires immense restraint. But if you don't reinforce the foundation, adding the wheat of rapid growth will collapse the entire firm.
So what does this all mean? If we distill this entire 2026 playbook down to its absolute core, the lesson is clear. The future of professional services, whether you are an accountant, a lawyer, a marketing consultant, or an IT provider, belongs to the specialized, the productized, and the
Yeah.
tech-enabled. It is about selling peace of mind and tangible outcomes, not tallying up hours on a clock. For you listening right now, whether you are in the market to hire a service provider for your business or you're running your own professional service firm, you have to look objectively at your operations and ask yourself the hard question. Are you operating like the chaotic, outdated roadside diner? Or have you built the premium, hyper-efficient omakase bar?
This raises an important question, and it's one that builds directly on the automation trends we've reviewed today. We see that AI is already driving massive productivity gains, perfectly automating that baseline foundation tier of transaction categorization and reconciliation.
Right, the machine does the baseline.
Exactly. So if we project this forward into the 2030s, as the machines become flawless at organizing the past, will accounting firms stop dealing with the raw numbers entirely?
Oh,
Will the successful professional service firm of the future evolve into pure strategic therapist for business owners? A reality where the spreadsheet is handled instantly by the machine, and the highly paid human is just there to manage the founder's financial psychology, their strategy, and their fear.
wow. Strategic therapists for founders, that completely reframes how we value human expertise versus machine efficiency. The machine provides the data, but the human provides the courage to act on it. We want you to ponder that exact future, look at the underlying mechanics of your own professional playbooks, and keep diving deep.
If you got value from this, share it with someone building something real. And if you want to stay sharp on go-to-market, follow Neon Primer GTM. We'll be back with more.